Welcome to Dividend Stockpile, where we talk about all things dividend income investing related. Today we are joined by Chris Dagnes, partner and equity portfolio manager at Hamlin Capital Management, where he runs their equity income strategy, the dividend-focused strategy that we'll be covering today. Hamlin Capital Management is a SEC-registered independent investment advisory firm catering to high net worth individuals and institutions. Chris, welcome to the show.
Thanks, Jeremy. Looking forward to a discussion.
Yeah, excellent. So I got introduced to you through another person, and they said you absolutely have to go talk to Chris. After looking through Hamlin's website, I love your strategy, and I definitely wanted to have you on to be able to talk about it to our audience. I think it was going to fit really well. So with that, can you give a brief introduction to yourself, as well as a little bit about your company?
Sure, Jeremy. So I graduated Bucknell University in 1999. I did a internship at a money management firm in 1997, the summer of 97. So that gave me sort of an early look and feel to the investing world and really sparked my interest. And every non-accounting class I took from then on was investing. So I went to work at Merrill. I was in the municipal bond department in banking, public finance banking, and it was a brutal couple of years. Everything you hear about investment banking is true. And after 2 years, I was trying to think about my next steps. In the meantime, something was happening in the markets that helped me with those next steps, and that was the internet bubble and preceding, crash. And I got my first bonus at Merrill Lynch at an inopportune time. It was the summer of 2000. And at the big firms like that, they don't want you sitting around managing your money. So they give you an advisor to use. And so they had given me an advisor, and his recommendation with that first bonus, which wasn't a lot of money, but to me it was a lot of money at the time, was to buy these 5 stocks. And he told me what the 5 were, and he was the expert, and I thought that made sense. And it's all the names you would have thought of from that time period: JDS Uniphase and EMC and Cisco. Well, within 8 months, never has anyone seen money evaporate like that. So my bonus was gone, basically 80% gone. And I really started to think, I'm probably not the only one this happened to. This is not pleasant. This is not fun. I don't want this to happen to other people, and I'm going to do something about this. And it was around the same time that I got a call from the firm I'm at now. So this was mid-2001. And Hamlin Capital Management. They reached out to me. They reached out to me because I had interned here at the predecessor firm. So that was the firm I had interned at in 1997. And so I had contacts here. They knew who I was. And I thought, this is perfect because of what just happened to me, and I'm sure a lot of others. And I really want to be a better investor and learn the nuts and bolts right away. So that's how I really got into the business, and that was 24 years ago. Maybe just a little bit about Hamlin Capital. So Hamlin has 2 strategies and was formed in 2001, as I said. Those 2 strategies are a high yield municipal bond strategy and the dividend equity strategy that I co-manage. And those are the only 2 things we've ever done. And so at the time in 2001, the firm was overseeing maybe a little over 200 million in assets. And these 2 strategies were about 50% in each of our assets. And they've grown sort of in lockstep, almost by accident, over the last 24 years. So today we only do those 2 things. We would consider ourselves specialists in these 2 asset classes, both income oriented, high levels of income from both. And, the concept was that our clients, they have wealth, but they didn't have necessarily money to spend, and we were going to give them access to that through investing. So today, we're overseeing a little over $9 billion, still about 50% in each of these two strategies.
It seems like your dividend strategy is very in line with the way I approach things. So I'm really looking forward to digging in as much as we can, talking about the strategy, philosophy, kind of what you look for, those types of things. Obviously, you guys have those two strategies, and you kind of talked about the things that were happening around the investing universe when they started this. But what was it about dividend investing that drew you to it? And also, why did Hamlin decide to focus on that?
Yeah. Well, there's some sort of softer, intangible reasons. I mentioned one, that the flexibility it provides to clients to have some actual money to spend to access your wealth. Compounding income is a very powerful force in investing. There's something really nice about keeping up with inflation, your purchasing power keeping up with inflation. And a dividend strategy, if done right, allows that to happen. If you just think about history, inflation has averaged sort of 3.5% over time. Well, the S&P has grown its dividend a little above 6% over time. So one way, and a very obvious way to keep up with that as you get older, as you think about retirement, would be to be invested in a dividend type of strategy that's very different from a bond strategy where that income stream is never going to grow. Mm-hmm. You hope you get your income and principal back, but you're not going to see that income stream grow. It's a totally different way of thinking about things and thinking about the world. And this is not a bond strategy, right? This is a income growth strategy, and you can have both. So those are sort of soft reasons, but the maybe more obvious reason is that there's a lot of data out there that suggests that your chances of success in equaling or beating the market over time by investing in a dividend strategy are higher. Dividend paying stocks have generally outperformed non-payers over the last 100 or so years. And it has been fairly consistent. So this seems like a very obvious thing to have that sort of tailwind behind us when working with clients and their money and our own capital. Put your clients' money in the path of good fortune by investing in a dividend strategy. Now, why is this the case? We spent a lot of time thinking about this. Why have dividend paying stocks outperformed over time? And there seem to be two obvious reasons. One is that they go down less in a down market. There's a very positive downside capture attribute to this strategy. Now, why would that be? Well, income is always positive. So the stocks we invest in can go down along with the market, but we're getting a more tangible form of return that is almost guaranteed to be positive in our yield, right? So we have a tangible piece of return, whereas investing in a non-payer, you're just hoping to get a higher stock price to have someone buy you out at a higher level. And that can work over various time periods, and you can do great things investing that way. But ours is going to be a little bit more of a tangible return. So income is always positive, even in a down market, makes us probably look smarter than we are. And that's very helpful. They also go down less in a down market because we think there's less selling pressure on what we own when stocks are going down, when the market is falling. And we have these events over the last decade, and we just had one in April where stocks fell pretty precipitously over a 30-day period, almost dropping 20%. And dividend ETFs, dividend strategies, they didn't go down as much. And that is because investors are holding on to our stocks. A lot of them for income. They're living off of the income that these companies are generating for them. And just think about all the good that holding does for you, because people can't help themselves. It's very scary in a down market, and you can make a mistake. You can sell at the wrong time, and then you're not assuming you need to get back in quickly, but you do. and you can never guess the bottom, and you can never guess the top. So what is that saying? Time in the market over timing the market, right?
Mm-hmm.
So a dividend strategy keeps you in the market, again, making you look smarter than you are. So the downside capture, very important. This is why dividend investing, one reason we think it has outperformed over time. Now, there's something else that is harder to put a finger on, harder to understand. But what we have seen, and there's some data out there that suggests this as well, dividend paying stocks, companies that pay out a lot of their earnings in a dividend, can grow their earnings more consistently and even faster over time. And that doesn't make any sense because we've all been taught reinvest more for faster growth.
Mm-hmm.
And that should be how it works. But in practice, it doesn't seem to work that way. And so that's sort of our core hypothesis within this strategy, is that what's happening is that the dividend is functioning as a governor on the capital allocation process. It is imposing discipline on a management team, and management teams can make mistakes. It's very hard allocating capital, deciding what to invest in with whatever excess cash they have, buy back their stock, pay down debt, reinvest into something in the business, make an acquisition. A lot of these are poorly timed. They make an acquisition at the wrong time, or more often than not, it's not a great acquisition. They buy back stock too high. They're doing all these things. Well, with a dividend, you've made a commitment. You're trying to keep that commitment. You're trying to grow it over time. And so we think our companies, the companies we get to invest in, have to make better decisions. And so that's really it. Long-winded answer to your question of why dividends. But that is why we think dividend strategies have generally outperformed over the very long period.
Yeah, those are absolutely great selling points, if you will. I feel very similar in my approach and why I picked dividends. I think that also, in addition to not wanting to sell off your income makers, like you're not going to sell your dividend stocks as quickly because you're relying on that income, but also you have the people who are trying to go from the high growth names into some kind of safety, and they tend to fall into your stable dividend pairs. So there's like a market, I don't know what the word, but it's some kind of like floor, if you will, on how low the dividend stocks will go, because people want that safety. They want that higher yield, in addition to everyone that's just holding on to their stocks already. So it's like a double benefit. If you're relying on the income, you don't want to sell the asset that's giving you that income. So to your point, it gives a little bit more stableness to, those large sell-offs like we've seen. So, and going to your point about capital allocation, a lot of these companies will decide to do buybacks when their stock's at all-time highs, or they'll make an acquisition because they feel like they have all this extra money when that other company they're acquiring is probably selling at a premium. And so to your point, having a dividend policy in place forces them to be very specific on how they spend their extra resources to make sure it will grow the business in a responsible way. So I think all those points are right on in my book.
The dividend is a stabilizer, and it provides a shock absorber.
Yeah, that's a good way of saying it. Yep.
That is what we often say.
Yeah, no, that's perfect. So during that discussion, you were talking about buybacks. And I know there's this ongoing debate between which is better, a company buying back their stock or paying out a dividend to their shareholders. A lot of people are in the buyback camp saying it's more tax efficient, because the company's not taxed and we're taxed, all that stuff. But buybacks, when they happen, you still have to sell your shares to make income. So what is your view on the debate between buybacks and dividends? I think I know the answer, but can you kind of give us both sides of it?
Yeah. Well, your point is well taken on being more tax efficient because a dividend is forced on you. A buyback is not. However, if you are living off of your capital, then at some point you need to access it. And so in that case, we generally think tax neutral. And tax neutral really starting in 2003. So that's when the tax law was changed so that dividends were then taxed at your marginal tax rate. So in a way, or dividends are taxed at their own ordinary income rate versus your marginal tax rate. So historically, dividends were actually taxed at your marginal tax rate. And it wasn't until 2003 that we got the 15% dividend tax, and cap gains long-term were brought down to 15%. That went up a little bit with Obama and the Obamacare tax on top of that. But the fact that they are equal and even, cap gains and dividends to us, means tax really shouldn't come into this equation. So then it comes down to what is better for the company. Now, we are not necessarily opposed to a share buyback if the company has plenty of cash. We don't want it just sitting fallow on the balance sheet. So a buyback could make sense. What you said is very important. Companies have a poor history of timing it. So if there's a way to make that buyback a little more formulaic in terms of let's do more when the stock price falls. Let's be out there in the market supporting the stock price versus chasing it higher. But unfortunately, companies have a long history of chasing it higher. Now, as a dividend investor, there's one great positive about a buyback. It reduces the share count. And so when we receive our dividends per share, if they reduce the share count, the company can grow the dividend per share, potentially even more, and without increasing the absolute level of dividends. In other words, if a company is buying back 5% of their stock, they can raise the dividend 5% and never increase the amount of cash they're paying. That's great for that company because hopefully they're also growing their free cash flow and they're priming the free cash flow statement for future dividend growth. So we like that aspect. But I would generally come back to the fact that the dividend is a commitment. It is a governor on the capital allocation process. And since that is why we think this works over time, a buyback does not do that. Management can put it on, take it off. They can stop buying back their stock. You have no control over that. Whereas a dividend, you do have some control because that company does not want to cut that dividend. They know what happens to their stock if they do. They're going to try to manage the business around it and around growing it over time. And these are all things that are not on their minds during a buyback. So that's generally why we're more favorable to dividend. We think the buyback does not impose the same discipline, and management is not focused on buying back stock when their stock price falls the way they are focused on continuing to pay that dividend. I mean, even in April of this year, we had a handful of our companies in the portfolio announce a dividend increase. And, we'll see how many companies were buying back more of their stock. But companies tend to sit on that cash when things are uncertain out there. And April brought a lot of uncertainty.
That's for sure. So the other thing I don't really care for on buybacks is the company will announce like a huge buyback, but there's no guarantee that they're actually going to do it or when they're going to do it. You hear these examples of, $80 billion buyback authorization. Yeah, they're authorizing it. Doesn't mean they're actually going to do it. And they're not going to do it at the best price. They're going to do it whenever they feel like it. And so again, with your dividend, they've made the commitment to every month or every 3 months, whatever their policy is, to pay out that cash to their shareholders. That's tangible money that we can decide to reinvest in the company if we want, reinvest it in a different company, or use the money to live and to fund our lifestyle. So I think the dividend strategy is much more stable than relying solely on buybacks.
Dividends have rarely been cut over the course of history. And if you were to chart the buyback line, it would look very different.
Yeah, for sure. So looking at your strategy, what I've seen online and I talked to you about, it looks like you guys are more focused on the dividend growth side of dividend investing. There's some other fund managers and other investors out there that focus on the high current dividend yield. They're not too worried about the dividend growth. Can you kind of state your case of why you feel like dividend growth is the more appropriate policy than a high dividend yield?
To answer this question, I would tell you we are very much a hybrid, and we want yield and growth. There's plenty of data out there that suggests that the higher the dividend yield, the better the returns up to a point.
Okay.
The highest yields do not tend to outperform. So there is a group of yields, and we like to cut it up into quintiles. of dividend yield. So quintiles 1 through 5. Quintiles 4 and 5 would be the highest grouping of yields. And what you will see over time is that it's not the highest, but the second level down has shown the best returns. So quintile 4. Quintile 4, there is some small portion, probably the low end of quintile 5, but quintile 4 is where you find a lot of high quality companies where maybe they're a little more, maybe they're cheaper than they've been over history. Their yields have risen a little bit, but their yields are not too high, because once you get into quintile 5, you have to deal with what we call the yield traps. Now, some people call those value traps. Well, it's the same thing. Yield trap is even harder because you think you have the yield support. And so you're willing to hang out and continue to receive the payment. But what you don't realize is that that company may need to cut that dividend. And the yield is telling you that. So in quintile 4, in sort of that the lower grouping of yield, you can have both. You can have pretty decent dividend growth and pretty decent yield, and that is where we exist. So we want to balance. Dividend growth is extremely important. Companies that are growing their dividend are likely growing their cash flows, their revenues, and this is an equity strategy. And so you want companies to be growing. It is certainly one way to avoid the yield trap, is to actually have top line growth. And it doesn't need to be double digits, low single digits or higher. And if companies can leverage that into mid to high single digit earnings growth, then they can continue to grow their dividends over time. So we're very focused on that. As I said earlier, we love to see dividend growth keep up with the rate of inflation. Companies that can do that, we think, are very valuable. They probably have a very good business model. And investors might be willing to pay up for that. So we just like the blend. We like a decent yield, and we like a strong level of dividend growth. One thing I like to do is I like to add the yield and the dividend growth rate. This is a very simple thing to do. And if you can get a 3% yield and 6 or 7% dividend growth, if you can get that number to 10% or above, that's usually a pretty good recipe. I have become a little more negative over the last 5 or 10 years on the higher yields. I think the market has become more and more efficient, more discerning, has figured things out. When stocks yield today, if a common stock has a big yield, call it 5% or higher, it does not believe in the sustainability of that dividend. There's something wrong. The company doesn't always even know there's something wrong. They may be about to get a call from their rating agency that says, we're going to downgrade your debt. Your rating is going down. And they may decide, yikes, we have to cut the dividend because we need to get the leverage to a level that they are not going to cut our rating. That can happen very quickly to a company. Or there could be a regulatory issue that is coming at them in whatever sector they're in, financial, healthcare. And investors are figuring it out and realizing that dividend is not going to be money good for the next 5 or 10 years. And so the yield is going up. So I think you just need to be more and more careful in terms of having too high of a yield. REITs and MLPs are a little bit different, and there's different tax treatments and different ways that they trade alongside interest rates. But common stocks, generally, when their yields get too high, it's a warning flag. It's a temperature reading. Something's not right with the patient.
Yeah, that makes a lot of sense. And to your point, there's so much information out there, and there's so many investors and different things that the market picks up on things pretty quickly. And they're always looking ahead, 6 months, 12 months to see what they think the picture is going to look like at that time. So a lot of the times the market is ahead of the company news, like you said. So when you have a stock that used to be in the 3 and 4%, but now it's in the 5 and 6% yield, it's the market telling you, hey, something's not right here, and you really need to take a better look at it. So it sounds like you guys follow, or at least like the idea of what they call the chowder rule, where if you add the current yield plus a 5-year dividend growth rate, 10 to 12 is about the number you want to look for to find that perfect balance between the dividend growth and the current yield.
I think that's, I think that's, I didn't know the name of the rule. But it's something I've always used. So
Yeah.
very much, a fan of thinking that way and trying to do that.
Yeah. So I don't know if this person Chowder came up with the rule or if he just coined it, but yes, your current yield plus your 5-year dividend growth needs to be around 12% for your middle of the road dividend companies. Utilities can be a little bit lower, and of course your high growth. So if the yield is only 1%, you're going to want a much higher growth to make up for the lower dividend. But like that equals 10 to 12 is like the sweet spot according to this rule. So seems to be
sense.
a very common strategy, even if you don't call it the Chowder rule, and it probably has a long history of proving right. So it kind of goes back to your point where something in the 3 to 4% range that's growing 7 to 8% a year is like that perfect balance. So I guess with that, let's dig into your fund's equity strategy a little bit. So obviously I know there's certain things you can and cannot talk about, but can you give us like a high level on what your strategy looks for when it looks for dividend companies?
The most important thing investing in a dividend strategy is sustainability of the dividend. So everything we do revolves around ensuring that dividend is stable, sustainable, it's going to grow over time. That is the key. And so there are certain key metrics we look for, just a starting point to put our portfolio together. By the way, our portfolio, 25 to 30 holdings, pretty concentrated. We'll invest in any sector. We're mostly large and mid cap, but we're willing to generally look everywhere for this key criteria, which are, there's really 5 things we're thinking about. Number 1 is yield. I mentioned we are on the higher yield, but not too high yield. So we generally try to double the yield of the S&P. When we make an initial investment, the S&P today yields 1.4% or so, which is very low historically over the last 50, 60 years. Tends to be more like a 2.5 or 3. But today it's 1.4, and that is very important when identifying your universe. As we said, too high of a yield could be a problem. 2 times the yield, high 2s, 3%. That's a pretty good starting point for us. Second criteria, dividend growth. Companies have to be focused on it. It has to be a very important part of their capital allocation philosophy. We want to see a path to dividend growth to keep up with the rate of inflation or more. And we've done better than that over time. Last couple of years, it's been more like high single-digit dividend growth, but it's got to at least keep up with the rate of inflation. So that's our starting point: dividend yield, dividend growth, and then sustainability. So the third thing we're very focused on is the balance sheet, low debt. I already sort of got into that a little bit, the problem that can happen there if your debt is elevated. So low debt. A number of our companies in our portfolio are net cash positive. They don't have debt, or they have more cash than debt.
Yeah. So
we generally target less than 2 times on a net to EBITDA leverage ratio. Or less than 50% net debt to capital. There's a couple things we look at, but generally the idea is low debt. And then dividend coverage, the fourth thing, dividend coverage. So very important. We focus on cash flow, free cash flow. So how is the dividend paid? It is paid out of cash. There should be plenty of cash generated in a year to pay that dividend, and we like to see excess. So even more than the dividend generated in a year. A ratio we think about is 1.5 times free cash to dividend coverage. If you can maintain that, then you have plenty of cash to do other things to help grow the business, which I've already said is extremely important, to pay down some debt, make an acquisition, weather a downturn, right? Yeah. So maybe the economy slows a little bit. Maybe there's nothing wrong with your business or your company. It's just a macro slowdown. And companies that have well-covered dividends are going to get through that. And then the last thing, just a sort of all-in quality metric, would be returns on equity We like to see that over a 5-year average period in the low teens or higher. So that's what we're looking for. We're screening all the time, a Russell 1000 type of universe. We include ADRs in there and sort of a little bit of everything. And the great thing about what we do is there's not thousands of companies that meet that criteria. Maybe there's 200, 250. Maybe it got to 300 in mid-April. So we have a list of companies then from which to do the real work on. And that is what I spend most of my time doing. So I love coming on a podcast like this and telling everyone what we do and how we do it. But I am spending the vast majority of my day on the phone with companies, reading filings, presentations, Ks and Qs, talking to experts, talking to formers, and trying to figure out if we're investing in good businesses. Are these high quality businesses that have obvious growth drivers, that do something different, that are competitive, have nice competitive differentiation, real competitive advantages that will allow them to grow their market share, and that have management teams that are maniacally focused on returning cash back to shareholders. Those are the things I'm looking for. We love a simple business, easy to understand, and we like to be buying it at a valuation that is not excessive. We hope to be buying it at a discount to what we think it's worth. And we're lucky again, we get to use a dividend discount model. Valuing a company is not easy. But when you have something as tangible as a dividend stream to value it on, we actually have a price target usually that makes a lot of sense. What is the yield going to be in the future? What should it be? Well, we have a lot of history on that. What are they going to grow their dividend? Well, we sort of have an idea of that. And we come up with a valuation, and we like to buy stocks at discounts to what we see their fair value. So that's it. That's how it all comes together. We're in just about every sector. We're sort of sector agnostic. We try to be as diversified and balanced as we can amongst end markets and sectors because we are concentrated by position.
Yeah, there's absolutely so much valuable information you just shared, even for someone building out their own individual portfolio. A couple of points that I wanted to reiterate is quality is so important. If you're doing any kind of research on an individual company and you're deciding not to do the ETFs, you really need to understand your company. You really need to find the quality companies that can sustain that dividend, grow that dividend. They have the cash flow. They're in a competitive part of the market where they have a chance on and continuing to grow and to continue to compete. There's so many people that have been invested in companies who are on the decline, but they just love that yield. You really do need to look at the fundamentals if you're going to be an individual stock investor. I think one of the biggest things I look for, quality in general is what I look for, but it's the debt ratios that I'm really concerned with, because when the company has income coming in or cash coming in, they have, limited choices of what they can do. Pay down debt, pay it out to you, buybacks, so make an acquisition. If their debt servicing is so high that they're focused 100% on just repaying that debt, the dividend's not safe. And so that's always one thing I really focus on is a very low debt or manageable debt, depending on the industry, to really make sure that, they can sustain paying me as an owner and they don't have to cut that off in order to pay the debt. So I think that's really good. 25 to 30 companies is typically, the sweet spot when it comes to diversification. Once you get much farther over that, as long as you're properly diversified amongst segments, you don't really gain a lot of safety by going over that. But you have to be really confident in those names if you're only doing the 25 to 30. So doing that extra homework, it really does make a difference. And it sounds like that's what you guys are focused on.
Yeah, I think that's right. I mean, there's been a lot of studies over time that say you can buy 15 to 20 companies and be very diversified. And we're believers in that. There's no need to overlap end markets. But if you have this key criteria, you should prevent a lot of mistakes. And if you've been doing this a long time, you sort of have the pattern recognition of what can go wrong and what does it look like.
Yep.
And so having that history and seeing where there are problems and companies that ended up having to cut their dividends, it's rarely a surprise to us when it happens. And just having that history, I think that allows us to avoid some real mistakes.
Yeah, absolutely. As I always tell people, if you're going to do individual stocks, you have to be able to put the work in and the time to keep up on them. Now, dividend investing is not a day-to-day type of thing, but you at least need to look at the quarterlies and the yearlies, look at some commentary, read what the management is saying to really understand. And once you get over, 30 to 40, even some people 50 stocks, it's really hard to keep up with them all. So you have to make a decision. Do you have the time, and do you have the understanding, and do you have the ability to really dig into some of these companies you're investing in? And if not, it's perfectly fine. Go with a dividend ETF or hire a company like yourself to run a fund for you. But you really need to make the effort if you're going to go with individual stocks. So many times people have gotten burned because they don't really know what they own.
Yeah, we're a team of five here on the equity team, focused 100% of our time on the 25 to 30 stocks in the portfolio and the 10 to 15 that are trying to get into the portfolio. And I agree, it would be hard to do have a lot more names with even with our expansive team.
Yeah, it makes a huge difference. So I guess with that, what does your company offer when it comes to individual investors, or how can someone work with you?
So we're accessible through a couple of areas. We manage separate accounts. You can go to our website at www.hamlincm.com and contact us through there. Just reach out to us through there. We offer a mutual fund in this strategy that anyone can look up on Morningstar, and that's accessible versus at Schwab, Fidelity, and a lot of different places. So those are sort of the main ways to access our management.
Okay, awesome. Can you talk to us about some of the current holdings in your strategy? If you can give specific names, that'd be great. But just a couple, just to give people an idea of what you guys feel is a good quality company.
One good example of a Hamlin type stock is a company called Old Republic. This is a Chicago-based property and casualty insurance company that is just under a 10 billion market cap and has been around a really long time, but still so few actually know it. But Old Republic has been growing its dividend for 44 straight years. It still yields over 3%. They just raised their dividend a couple of months ago, 9% for the year. So Jeremy, we can do that chowder roll. 9 plus 3 is 12. That seems pretty good.
Yep.
Old Republic is big within commercial auto. That is what they are most well known for. But they're also the number 3 title insurance company in the country. They, if you think that the housing market could improve at some point, that's going to accrue to the title insurance companies as turnover picks up. So that could be a impetus for the stock price to go a little bit higher. But that dividend is extremely well covered. They are a cash return machine right now. So Old Republic in the last 12 months just did something around $1.3 billion of free cash flow, while the regular dividend only costs them about $290 million. I just mentioned that's at a 3% yield.
Mm-hmm.
Oh, and by the way, they're buying back a lot of stock because $1.3 billion minus 290 is a lot of excess cash flow.
Yeah.
So they've been buying back a significant amount of stock, which means that their dividend per share is going up, but their absolute dividend payment has barely been going up, as business has been quite strong within insurance over the last couple of years, especially within their commercial auto line.
Yeah.
That is a company we still like. It still trades at 11 and a half times earnings. And so we think reasonably valued. They also just paid a $2 special. So
wow.
as I said, this company is a cash flow return machine right now. The CEO, Craig Smitty, is doing a great job. They have a very sort of entrepreneurial culture for such an old company that's been around 100 years. So that's one example of a company we own and have owned for a long time. Maybe another example, a company called Lamar,
Mm-hmm.
Lamar Advertising. So this is advertising. It's a billboard company. This company owns 150,000 plus billboards all over the US, mostly on highways and roadways. They also own something around 5,000 digital boards.
Mm-hmm.
So you have an analog board and a digital board. Well, 5% yield here at a pretty attractive, we think, price to FFO level, and a very strong balance sheet. A company that has been run by the Riley family. Sean Riley is the CEO. I think his grandfather started the company. It used to be a radio company. I mean, so we love, family-run situations like this. But even this, again, very entrepreneurial in how they run this business, which we like. The interesting thing here is just how irreplaceable these assets are.
Mm-hmm.
You cannot just put up a billboard.
Yeah.
There are lots of rules and regulations around where a billboard goes, and they own them. So the other thing you can do with a billboard is you can transition it from analog to digital. Now, you can't do that with all of them. There are rules and regulations around that too. But there is something like 25, 30% of their billboards over time that they will be able to transition to digital. And when you do that, you get to charge more, because instead of having one advertiser on there for a month, you might have many. And so immediately the revenue per board pretty quickly pays the CapEx of putting that digital board up. Just a good business, because it is getting harder and harder to capture the eyeballs. And what's great about Lamar is it's mostly local advertising. 80% of their business is local, only 20% national. And, if you're a real estate agent in town, or a dentist in town, or a lawyer, you're trying to get in front of your potential customers, there's not a lot of ways to do it anymore. Yellow pages are gone. Local TV, people aren't really watching linear TV anymore, so the billboard is becoming more and more important. So been a very nice dividend growth story over the last couple of years, still at a 5% yield, with we think reasonable valuation. So that's another one in the portfolio that we like.
Yeah, I really love both of those. I own ORI right now, and I've owned Lamar in the past, so those have definitely been on my radar as well. I love Lamar because all the metrics when it comes to them, it's just like fantastic. Like, it's amazing how good of quality they are, and to have that high of a dividend is really something quite impressive. And I believe that they're set up as a REIT, so I think they own the land that the billboards are on as well, and those are usually in the prime locations where, to your point, you can't get those spots anymore. So they have a real competitive advantage in my mind.
You know your stuff, Jeremy. They are they transitioned to a REIT 2013 or 14, something like that, and they own the land under those boards. That is how that works. Or they lease the land under the boards. They own the actual physical structure of the boards, and those are like 100-year leases. So that's generally how that works.
Because billboards have been around so long, a company like Lamar is going to have their prime locations already. And, to your point, you just can't pop a billboard wherever you want. So there's definitely some, competitive advantage that they have. So it's definitely something to look into. So I appreciate you giving those names, kind of put a name to the strategy, if you will, so people can do research. Not necessarily those two holdings, because, you have to do your own research and have your own conviction. But that just gives you an example of the type of quality that Hamlin looks for when they're building out their portfolio. So I really appreciate you being able to give us some details. So you mentioned it earlier. People go to your website. Are you on any other kind of social media, or any other ways for us to follow you as well as Hamlin?
I mean, as you mentioned, I'm on X. I'm not that active a poster, but every once in a while I will share some thoughts generally related to what we do in dividend investing, more macro dividend investing. So that's really it. You can find us on LinkedIn and various other formats, or just go to our website. Awesome.
Well, I really appreciate all your insights on how to think about a dividend strategy, how you guys are implementing it in your funds and in your strategies, and give us little bits of insight on someone who professionally does this day in and day out, of the types of companies to really look for if you want to focus on quality, sustainable dividend growth companies. So, Chris, I really appreciate you coming on.
Thanks for having me. Hopefully it came across that this is what I do.
Yep.
This is all I do. This is all we've ever done as a firm. We think about dividend strategies day and night for the last almost 25 years now here at Hamlin, and we think we're sort of specialists in this type of strategy, and we think it's a all-weather strategy. It sort of makes sense for just about everyone. Most of my family is invested here, and they have big dividend portfolios, and it's just what we believe in.
Yeah. And, obviously I've been dividend investing for a long time. And so when I was researching your fund, it's like every single thing that you listed as one of your qualities you look for is exactly what I look for. So it's like a perfect fit for my style of dividend investing. So everyone definitely go check them out, check out their website, check out their strategies, see if one works for you. Not a recommendation, but it definitely, you have a very strong plan in place on what to look for dividends, and you guys have been doing it for a long time. So everyone check out Hamlin, see if it works for you. And ask any questions you have. If you want to put comments down, I'll make sure that it gets back to Chris and we can get an answer for you. Or you can follow him on social media and go to their website. All right, Chris, thanks again. Really appreciate your time. I'll see you next time.
Great. Thanks, Jeremy.